All right, hello everyone. I want to talk a little bit about market makers and hedge funds because I know a lot about this stuff. Okay, I was a market maker for 2 years. I oversaw the trading of, probably a dozen different hedge funds. And after I kind of, whatever, decided to go into the next phase of my life, the quote unquote give back phase, I just thought there would be a lot of room for education because there's a lot of myths out there. And sure enough, when I got into the retail world, teaching people, my my suspicions were confirmed. There's a lot of myths about Wall Street. I can speak about market makers because guess what? I was one for 2 years. I can speak about hedge funds because guess what? In my 20 years, or 25 years, I oversaw the trading of a bunch of different hedge funds. A hedge fund doesn't necessarily need to be a standalone entity. It could be under the umbrella of an institutional investment manager where there are various hedge funds, and that's what I did. All right, so let's just go on and let me just dispose some of these myths, and hopefully I don't get into too long of a rant. Okay, let's talk about the institutional money world. Institutional money management world. We have mutual funds. We have traditional institutional investment funds, and we have hedge funds. These are money managers. They manage money for other people. Some people think that hedge funds are, these oligarchs that are just managing their own money, throwing it around, trying to manipulate the markets. No, 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 no. That's not the case. Most hedge funds, the vast majority, probably 98%, are managing money for other people. Hedge funds make money if they do a good job because they manage money for things or for their clients. What are their clients? The pension plan, the endowment. So on the institutional money front, we have mutual funds, which probably everyone who's listening to me knows what a mutual fund is. We have your traditional investment funds, and we have hedge funds. This is managing money. Now, let me just give you an example. A firm that I worked at had 6 products. It was an institutional money manager, but it had different products. It had 3 strategies. One strategy was micro cap equities, one strategy was small cap equities, one strategy was small cap value equities. So the mutual funds consisted of maybe 60 or 70 different stocks. These are there for the retail investor. They can invest $1,000, they can invest $5,000. The managers, they pick the stocks to invest in. That's it. Mutual fund. The traditional institutional investment funds might invest in the same exact things or maybe a little bit smaller, maybe the top 40 names or 40 companies, and they charge fees. But if you're an institution and you're having money managed by someone, say you're having $100 million money managed by someone, well, you can negotiate really small fees. If you're in a mutual fund, well, you're basically not going to be able to negotiate. You can't call up the Fidelity or wherever and be like, oh, I need to pay less fees. But if you're someone who's a institution, a pension plan, a church endowment, you can call up and say, hey, listen, I want you to manage my $100 million. You said you're going to charge me 2 million. Well, guess what? I'm only going to pay you 1 million. So that's the traditional institutional investment manager. Mutual funds or retail investors are pretty much on their own. And I'm not saying you shouldn't really, you shouldn't not think about mutual funds because some of them are pretty good, but you're better off with ETFs. But that's a different conversation. All right. So now we have the hedge fund, the mysterious hedge fund. When I came to the educational world, I was actually kind of shocked and kind of I don't even know what the right word is. Like I guess caught off guard. I don't want to say funny, but there's this mystery around what a hedge fund is. All right. again, we have our three investment products: mutual funds, traditional investment funds for money managers or for institutions that want to be able to negotiate, and you have your hedge funds. Now, there are two main differences between a hedge fund and, say, a mutual fund. One is only an accredited investor can invest in a hedge fund. That's just a fancy word for saying you either need to be an institution or you need to be a person who has some kind of a financial savvy. I don't even know what the minimums are anymore, but now it might be like, all right, to invest in a hedge fund, you need to have a net worth of, I don't know, $1 million and an income of $200,000, or maybe you have savvy in the investment industry because you worked in it. So I'm not really sure of the details, but I'm sure you can look it up. So only accredited investors can invest in a hedge fund, and believe me, you don't need to be that sophisticated to be accredited. You could just be some spoiled kid who inherited money and thinks they're smart, right? So this is the secondary reason. It's a minor reason. The main difference between a hedge fund and a mutual fund or a traditional strategy or a traditional investment fund. All right, you ready? You sitting down? It's the fee structure. I hate to bore you. I know you're probably thinking that, oh, gee, I thought this guy was going to tell me about the secret of hedge funds and blah, blah, blah. The secret is there is no secret. The difference is the fee structure. In a mutual fund or a traditional institutional money management fund, who's ever managing that money only gets the management fee. Say it's 1% a year, you get the management fee. Say you're managing a mutual fund, you get the management fee. All right. Mutual fund has $100 million in it. The management fee is 1%, and that's $1 million. Okay. Traditional institutional investment funds might say, well, we're going to give you $500 million, but we don't want to pay 1% because that's $5 million. So we're going to pay 0.5%. The difference is the hedge fund gets a piece of the action. That's it. That's the main difference. Okay. Notice how I'm circling this really fast. Trying to be a little bit dramatic here. So that's it. That's the main difference. A hedge fund can be extremely simple or it can be extremely complicated. I've overseen the trading of hedge funds that are as boring as things can be. They're as deep vanilla as things can be. It's a deep value equity fund, buys maybe at any given time has 10 or 12 stocks in their portfolio, maybe trades once a week, once a month. Hedge funds can also be extraordinarily complicated. They could use derivatives, they could use futures, they could use swaps, they could use synthetics, all these other type of things. The strategy can be applied in any context, right? And basically, if you're good enough that your returns are so good, you can start a hedge fund and you can get a piece of the action. You get the management fee, which let's just say we have the $100 million fund. So the mutual fund manager is going to get a 1% management fee, $1 million. The hedge fund, say they have a 1% management fee, they're going to get $1 million. Now let's just say that hedge fund or that mutual fund has a 20% return in a year. So now at the end of the year, what started as 100 million is now 120 million. Well, the mutual fund or the traditional institutional investment fund, they're just going to have to pay the management fee. Now, just to kind of make it simple, let's just say it's like 1.2 or 1.1 right in the middle there, right? If they made 20 million or if they were up 20%, let's just say, all right, well, you got to pay your $1 million management fee and it goes up by 20%. So you got to pay another 20% on your $1 million management fee. So it's a extra $200,000. Now the hedge fund gets a piece of the action. Let's say that they have a 1% management fee and a 10% performance fee. If the asset base goes from 100 to 120 million, that's up $20 million. What's 10% of $20 million? It's 2 million. So the mutual fund or the traditional investment platform or account is going to just get the management fee, right? Like whatever we said it was, like 1.1 million, just doing simple math. The hedge fund is not only going to get that management fee, it's going to get a piece of the action. So if you're up by 20% or $20 million and you have a 10% performance fee, not only are you going to get the management fee, you are going to get that piece of the action. You're going to get a $2 million performance fee. That's it, everybody. Sorry to disappoint you. That is the main difference between a hedge fund and any other type of investment firm. It's the performance fee. Hedge fund strategies can be very simple, they can be very complicated. A lot of hedge funds go out of business. For some reason, the retail investors think that, oh, the hedge funds rule Wall Street, blah, blah, blah. Guess what? There's a lot of hedge funds out there that suck. Somehow someone raised some money and they end up losing money for people. Hundreds of hedge funds go out of business, I don't know, every week, every month. Just like hundreds of new hedge funds are started every month or every week. Just because it's a hedge fund doesn't mean they know what the hell they're doing. Okay? There are hedge fund managers that are complete idiots that have blown things up. As a matter of fact, the last firm I worked at got taken over by a narcissistic idiot who thought he was smarter than everyone else. And when I joined the firm, they managed $3 billion. My understanding now is they manage 75 million. All right. This is a hedge fund manager who doesn't know what the hell he's doing. All right. So just because it's a hedge fund doesn't mean that it's great. It doesn't mean that things are, whatever. This person really knows what they're talking about. Now, there's slang in the market, and this is called, well, there's a lot of slang, which I won't put up here, but I guess the normal or innocuous slang, there's the buy side of the market. Okay, the buy side, it doesn't have anything to do with buying or selling. The buy side both buys and sells. These are your money managers, the mutual funds, the hedge funds. If they want to execute a trade, they have to go to a broker dealer. The way the law works is that if you want to execute a trade and you're a money manager, you need to go through a broker dealer. You, as a retail trader, are on the buy side of the market. You need to pay someone to execute your trade. So the buy side is the side of the market that has to pay commissions. Retail traders and then these types of money managers. Now, the sell side, and once again, it's slang. It has nothing to do with buying or selling. Both the buy side and the sell side both buy and sell. The sell side is the firms that get the commission to execute the trade. These are the broker dealers. Whether you're the biggest hedge fund in the world or you're someone who's trading $10 worth of stock as a retail trader, guess what? You got to go through a broker dealer. You have to pay a commission. So let's talk about the mystery of the market makers because as a former market maker, I'm almost a little bit offended at all of this like negativity around what market makers actually do. But market makers are people or teams who work on the sell side that specialize in a particular sector or industry. For example, I'm at my old firm and I am the head of trading for a mutual fund and a hedge fund. And I want to get an order executed, and let's just say theoretically it's in the industrial sector. So I called one of the brokers, could be Goldman Sachs, could be some firm you never heard of, could be this, could be that. I got to go through the sell side. I got to pay a commission. Now, if I call up with an order in an industrial stock, guess what? It's going to end up with the industrial stock market makers. These people specialize in this sector. This is all they do day in and day out is trade stocks in this sector. That's what a market maker does. The main job of a market maker is to work orders on behalf of their clients. The clients are the buy side, the market makers on the sell side. Market makers are experts that work at specific firms. Now, specific sell side firms, I should put that out there. Now, where does the term come from? Market maker. Well, they can make markets for you. I'm at my last money management firm I was at 5 years ago. All right. I'm trading for these hedge funds, these mutual funds. These are all various products that we can offer our clients. I want to buy an industrial stock. I want to buy 2 million shares of Dow Chemical. Okay. Just hypothetically. I call up a broker dealer. Let's just say it's Goldman Sachs. And I talk to the market maker and I say, hey, listen, I got something going on in here in this specific stock. Okay. Dow Chemical. Now, on Wall Street, a lot of times you don't want to show your hand. You don't want to tell them you're a seller or you're a buyer because if they don't get the order or they don't get a chance to make a commission off of you, well, they might use that information against you. I'm not saying it's unethical. This is how trading works. Someone could say, someone else could call in who's a much bigger client who pays a lot more commissions and said, hey, I want to do something on this particular stock. Do you see anything going on? And if you called up and you showed your hand and told them you were a seller or a buyer and you didn't go back to them with the order, they might tell this client that pays them more commissions, oh, we know there's a big seller around. We know there's a big buyer around. And that might alter what they do. If you tell them there's a big buyer around and they want to sell, guess what? Maybe they're not so aggressive. Maybe they raise the price they want to sell at. Maybe they don't need to be like aggressive and desperate to get out of it. And the opposite is true on the other side. So market makers trade these things. They have an expertise in this particular industry. That's all they do. Trade in and out of that sector every day. Next person might call up and say, "Hey, listen, I'm a seller of this," and just say they pay that firm a lot more commissions than your firm does, and you don't give them the order. They might be like, "Oh, nod, nod, wink, wink. We know there's another seller around, so maybe you need to be more aggressive. Reduce the price you want to sell it. Or if you're a buyer, back off a little bit." Now, here's where the term market maker comes from. I call up Goldman Sachs. I want to buy 1 million shares of Dow Chemical. Just say Dow Chemical is trading at 20. I don't want to tell this market maker what I'm doing because I'm afraid they might use my information against me. And I say, hey, I got something to do on 1 million shares of Dow Chemical. Make me a market. And they would say something along the lines of, okay, I will make you a market. The stock is at 20. I will buy 1 million shares from you at 19. I will sell you, or short, I will sell you 1 million shares at 21. They made the market. That's what a market maker is. And hedge funds, as we saw, the only difference between a hedge fund and a traditional money manager is the fee structure. So I'm sorry to bore you. I know you're probably thinking about like these really weird esoteric secrets about Wall Street, but I just got to say it as it is because this is what really goes on and this is the truth. And at stockmarketgeographer.com, we are honest and that's pretty much it. So if you have any questions, please reach out to me. Thank you for checking out my hedge funds and market maker lessons. Hopefully, from now on, you won't think that hedge funds and market makers are people that are evil. They're just trying to take advantage of the quote unquote little guy. And that's it, everybody. Thank you so much, and I hope to see you soon.